Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. On this episode, we're going to be discussing home improvements, the tax code and tax breaks. How much should you keep in your checking account? Fixed annuities versus CDs, and a look at the Plan Solutions Incorporated Office Bulletin Board. And of course, if you want to subscribe to the Personal Financial Review, the written content we discuss, send Katie an email. That's KATIE at plansolutions.com. Mr. Armour, how are we, good sir?
Doing good. Just got back from a guys' golf weekend, so that was a nice getaway, and we had a great time, good weather. And came back to Sacramento, where it's supposed to be like 114 this week. So try and survive that.
Yeah, right. I know. Plus, where we're at in California, they're doing all the fire burns so that it can help prevent against the bigger fires that could potentially happen. So, yeah, it makes for a very interesting time of year. But hey, California living, right? This is California, okay? It's not all Disneyland and beaches.
That's right. Yeah.
All right. Well, let's jump into our first topic, home improvements, tax code, and tax breaks. Hey, this is a great thing to jump into. I mean, you're kind of personally experiencing this, and it is seems to be a popular time of the year that people do start to do some of those home improvements. I know I'm working on some things here soon enough outside of the house, not necessarily inside.
Yeah, absolutely. And I think, with interest rates being much higher than they were, right? A lot of people have those low interest rate mortgages that they don't want to give up. So they're less inclined to sell and move if they're going to have to take on a much higher interest rate mortgage. So that instead they're, staying put and looking around the house and saying, okay, what can we do, to maybe fix up the current or existing house a little bit. So there's been a lot of questions about, the tax implications as it relates to home improvements.
Yeah, well, let's dive right in. I mean, what can you deduct?
Yeah, so it's a little tricky. I mean, in general, if it's your personal residence, home improvement projects are going to fall under the IRS code as personal property, which basically just means, non-deductible, right? Just personal expenditures like, food, clothing, everything else would fall into. But there are a lot of kind of areas around the edges, right? That then you can look at. So, whereas the actual cost of the home improvement may not be deductible, one thing that comes up is how you're paying for it. And if you're paying for it by taking on a mortgage or a home equity line or something like that, as long as money borrowed is used to buy, build, or substantially improve the home, then the interest can be tax deductible. So if you're doing a $100,000 pool or kitchen remodel or something like that, you may not be able to deduct the $100,000 expense, but the interest that you pay on the loan that needs to be secured by the residence as a legal mortgage, that could be deductible because you've put the money back into the house and it's treated similar like as if you use it to purchase it.
Yeah, that's a very useful thing. Obviously, I was going to ask you about that, if it had to be the way in which you went about funding these improvements.
Yeah, I mean, it does need to be a mortgage. The tax code is very clear about that, which basically is, money that's lent, that's secured by the property that is actually, recorded at the county recorder's office as a lien. Sometimes you run into that hiccup where, let's say it's an intra-family loan, right? And they say, yeah, I loaned it to them and, it's secured by the residents. Okay. But you need to take that extra step of making sure that it's actually recorded as such, because that's one of the things the IRS may look at.
And in that type of a situation, if it's like an inter-family loan, does it have to have interest upon it to also count? Or is it a situation like, hey, I'm just going to lend you the $100,000 and pay it back within a timely manner?
Well, there is what's called the applicable federal rate. It's an interest rate that the IRS publishes every month that they say basically this is the minimum interest that you need to charge. So the way they look at it is if you loan someone money that, that interest rate is being charged. If you don't actually require that they pay it, then they treat it as if, you're basically gifting them the interest back. So the person that's loaning the money is still going to have to report interest income in line with that applicable federal rate. And then, they could basically treat it as if the person paid the interest, they received the interest, pay taxes on it, and then gifted it back is how it would be treated. So a lot of times you do want to use that applicable federal rate because obviously the person lending the money, they may be happy to help out, but they don't necessarily want to be paying taxes on money that they didn't receive.
Right. Well, what about a situation, for example, we've talked about this before on the podcast that I'm an independent contractor. I do work from home. There are certain things that when it comes tax time, we do write off when it comes to the home. Is there anything applicable if you're self-employed?
Yeah, if you're self-employed and you claim the business use of the home deduction, right? So you qualify in terms of having a dedicated space in your home that's used exclusively for business. Then the way you would look at that is you would look at the percentage of square footage of the home that's used for business. So let's say it's 10% of the square footage is a dedicated office that's used for a qualified business. In that case, you would be able to deduct up to 10% of any repairs. You'd be able to add any improvements to the cost basis and depreciate that over time. You'd be able to deduct 10% of the interest if you're paying interest on it, and all of that. A portion would flow through to the tax return as a business deduction, which can be pretty helpful because not only does that potentially offset the income taxes from the business, but also the self-employment tax.
Yeah. Now, when it comes to the situation of repairs, I think sometimes that gets a little bit muddied. What kind of standards do they look at? Because let's say, for instance, the blinds in a room get damaged. Is that something that you can account, or is it actual structural repairs and improvements?
Yeah, so this is a very complicated area. We could probably do a whole podcast on it. The IRS released guidance a number of years ago, and I think it just made everyone a bit more confused. But generally, the idea of a repair is you're just bringing something back to its existing functional use. If something's damaged and you fix it, that's a repair. It's deductible in that year. An improvement is something that improves the quality or extends the life of it. And then there are some kind of other categories where you'd think it'd be a repair, but the IRS is pretty clear that it's an improvement. So it's definitely an area where someone should talk to a qualified tax professional to have an understanding. Because it literally can be down, if you replace one fixture because it's broken, that's a repair. If you decide I'm going to do all the fixtures so they match, that's an improvement. If you replace carpet in one room because it's damaged or you patch it or something, that's a repair. If you decide, well, let's just do all the carpet, that's an improvement. So it is a very tricky area, but it's also a very important spot because to the extent that a lot of these things fall under the improvement category, then they get added to the tax basis, right? So the tax basis is what you paid to buy, build, or improve the residence, and you add up that total, and you want to track it over time, especially for the big things. Because you just don't know in the future if it could have an impact if you come down to where you're going to sell the property. Right now, most people, if they've owned and lived in the home for 2 out of the last 5 years, when they sell, they can claim the personal residence exemption. So for an individual, they can exclude up to $250,000 in gains, and for a joint filer, they can exclude up to $500,000 in gains. So a lot of times when people sell, there's not a taxable event. But we run into it all the time where someone's been in the house for a really long time and it's appreciated significantly and they sell. And even after we exclude the $250,000 or $500,000, we still have a taxable gain. That's where you want all of those improvements documented. So you can add that to the basis because that can actually reduce the gain and potentially make it so that the sale of the personal residence is tax-free.
Now, do those improvement improvements that you would keep the receipts upon have to be in the year of the sale, or is this just overall throughout the lifetime of ownership of the home?
Overall throughout the lifetime of the ownership of the home, which makes it tricky, right? That can be a very long time period, decades. So it can be helpful to just have a file where you throw those receipts in, right? Or keep a ledger of this is what we spent and when and what it was for. Just in case you get audited, you can show, look, I paid this much. Obviously, I had to do improvements to keep this property up over the last 30 or 50 years. And these are, my expenses, and if they're reasonable, they likely won't be questioned. But you need to have something, right? You need to have something to be able to show it. Otherwise, really you're going to end up paying the tax.
Yeah. Okay. Thank you for that clarification on that. That's a great thing to note. I'm going to have to start a new file. What about, I know you see it. We get inundated with this in California. I'm not sure about other states, but I'm seeing these things. California will pay for you to install solar. What about solar panels, any sort of solar energy, things of that nature?
Yeah, I don't know of any real big state programs. There are some local, county programs where maybe you can get, some money to help. But then the other big piece is the federal tax credit, and it's one of the best tax credits out there, which, in essence, is just a flat 30% of all the cost of the, material, labor, you name it. And even in cases where some roof work needs to be done to make the roof structurally strong enough, then that also can be deductible. Although if the roof work is just done just because it needs to be replaced and it's not structural, then it would fall under that, personal expense. And so currently, the tax credit's 30% of that cost, which runs through 2033, and then it starts to slowly phase out after that. So, that can be a great opportunity to save on the monthly energy bill as well as get a big tax credit. Of course, we usually recommend running the numbers and saying what's the cost, projected cost benefit here, and how long is it to, break even on that investment.
Yeah, yeah. I think there's an immediate perception that all of a sudden energy's become zero cost, or because you're pumping enough back into the grid, and there you go, and it doesn't work that way.
Yeah, there are some definite intricacies there. A lot of times you don't necessarily want to get your bill down to zero because the first tier of energy costs is pretty inexpensive. It's you want to replace the more expensive energy that you're paying for. And then in a lot of places, there's a real kind of limited benefit as to how much you can get paid for selling energy back to the grid. And that's, put in place to protect the utility providers that, in essence, kind of protecting their monopoly, if you will. So yeah, a lot of times there is kind of a sweet spot in terms of how big of a actual unit that you want to invest in.
Yeah. Well, what about I have a friend of mine. They installed solar panels. Along with that, he drives an electric vehicle, and so he was looking at doing a charging station. What about that? If you have an EV and you want to install a charging station in your home?
Yeah, same tax credit rules apply. So 30% credit for most installs. There's a cap of $1,000 in terms of the tax credit, but in most cases that's plenty to cover what people are doing. We also see it with a lot of like battery installation, the battery backups that have become really popular, especially in some rural areas. And then there's a number of other energy efficient tax credits, which I won't really get into because we covered them in a past podcast in terms of, what qualifies, doors, windows, insulation, certain types of HVAC, things like that, which tend to be fairly small credits, somewhere in the $200 to $500 range. So it's really a fairly small percentage of the total cost. But if that's something you're going to be doing anyway, it does help to, get a little bit of an extra income tax benefit.
Absolutely. Well, and as you always say, these are great to explore with your tax professional. And noted here too is that there are a lot of very aggressive sales tactics around these things. So it's always great to examine these type of purchases before making a decision.
Yeah, there's a lot of overpromising in terms of what will be available from a tax credit without understanding the person's income, and whether or not they'll qualify because they're under the income limits, or what their tax situation is, and how much it may actually benefit them.
Yeah. Anything else you want to add before we move to how much should you keep in your checking account?
No, just, it's one of these things that's so particular, home improvements to an individual situation. It's just, if the tax benefits are a big driver of the decision, it's I think really important to, to talk it through with your tax preparer and have an understanding of what your cost benefit will be.
Absolutely. All right. How much should you keep in your checking account? What a great question to pose here. Really, I mean, how do we determine this? Is it a pretty cut and dry situation, or is it a little more complex based upon income levels and maybe monthly bills, etc.?
Yeah, it's a real balancing act between a lot of different considerations. The first, obviously, you don't want to have too little, right? Because, you don't want to be in a situation where you're always kind of right on a razor's edge and, potentially incurring overdraft fees or something like that because you overdraw your checking account by a little. You obviously don't want to have too much because that's money that's in an account that's not earning anything.
Mm.
And if you could shift that to a high yield savings account with today's interest rates, that can add up to real money if you can be earning, 4.5%, 5% on that money, that might otherwise just be sitting and not earning anything. And then you also have to think about just the risk factor, right? Your checking account is linked to the outside world, where typically a money market or a savings account is not. It's not directly accessible, to the outside world. The money has to be transferred into a checking account before it can, be paid out. And, with identity theft and fraud and all of those things, still one of the biggest forms of identity theft, even in this digital age, is check fraud. So, having a, limited amount in your checking account limits how much is someone can get access to. In a lot of cases, when it comes to check fraud, you're really at the mercy of your bank and their policies. So you want to do whatever you can to protect yourself from that. And then you want to make sure you have enough as a safety net that you're comfortable with. I think that's the one where for everyone it's different, right? Some people they need to have a certain amount to have a comfort level. For others that might be much lower. And so really, what allows you to sleep at night, I think, is also a consideration that differs from person to person that needs to be taken into account.
Absolutely. Well, and I think, I mean, really, how should people examine the purpose of their checking account when it comes to money? I try to look at obviously the liquidity of it, and examine, what are my standard bills and some, in case of an emergency type of situation, unexpected car repair or something that occurs that I can quickly pay for, that I'm not having to go on credit at a percentage rate that, a little bit higher than the cash, obviously, that I currently have. So.
Yeah, I like to think of the checking account as really, you take a kind of a normal month, right? Cash in versus cash out. And you get an idea of what that's at and have that amount in there, and then maybe you take 125% of that amount or 130%. So you have a little bit of buffer there. If, you have a month where you eat out a little more than normal, or you do something and you run over that. Anything else, you still need to have an emergency fund like you referenced, but you don't necessarily want that sitting in a checking account earning nothing. And again, being accessible to the outside world, because, chances are you're not going to have an emergency every month, or hopefully not, right? Maybe it'll come up once or twice a year. But if you have money in a, savings account or a money market account or something like that, that's linked to your checking account, you still have access to that cash. You can transfer it over quickly to, cover a bigger credit card bill or something like that because you had this emergency. And yet, that money is somewhat segregated from the checking account, and hopefully, actually earning something on those reserves.
Yeah, thank you for that clarification. Now I'm rethinking some of my strategies here. I mean, what's the overall goal of examining, how much you should keep in your checking account?
Yeah, well, like with anything in finance, it's usually not the extremes. It's somewhere in the middle, right? It's finding the right balance. And so this is one of those things where it will be different for everyone, right? Depending on their income, how much they have coming in each month, how much they have going out. What's a reasonable buffer to have based on maybe variability of spending from month to month. Of course, any, big expenses that they're anticipating, right? If they have, big vacation coming up or something like that, they may want to have, more access to a larger amount of money for that short time period because they anticipate a higher level of spending. So it's really one of those things where each person kind of has to decide, if your neighbor or your brother-in-law or your friend says, oh, I keep this much, that might be the right amount for them, but not for you. And so it's worth at least exploring, having that conversation, and trying to find where that right balance is.
Yeah. All right. Well, let's jump to fixed annuities versus CDs. Fixed annuities and CDs can, both be good ways to save for the future. We've discussed those on past podcasts, and you can get a little more clarity on each of them. But really, what are some of the differentiations, the differences between the two that have different things about them that are attractive?
Yeah. We continue to get some questions about annuities. I know we talked about it recently, and so we're kind of circling back again. And just because the annuities they can be so complex, there's so many different types, there's so many different details. And so it's something, and then as we talked about in the past, they can come up with lockup periods, they can sometimes have high fees. It's really important to understand, exactly what you're getting into. And one of the areas that often is compared is fixed annuities versus CDs. I mean, both are considered, conservative investments that, for the most part are designed to protect the principal, earn some interest, right? But, going through, there are some differences. Now, like CDs are backed by the FDIC, the Federal Deposit Insurance Corporation, which is a U.S. government agency and to an extent backstopped by the U.S. government, so considered very low risk. An insurance company, meanwhile, if it's a fixed annuity, really it's backed by the financial health of the insurance company. So there's a big difference there, right? I mean, an insurance company is not necessarily going to be bailed out where, in theory, if FDIC ran short of funds, there's a good chance that Congress would step in as we've seen in the past, or do things like, extend the amount that's covered, or we've seen a lot of different, especially through the financial crisis, we saw a lot of changes there. So, you can compare the interest rates and the fact that they're both considered low risk, but you have to realize one's maybe not quite as low risk as the other. And then, CDs can offer more flexibility in terms of, access to the money, the terms that are available, different time periods. There may be a penalty for getting access, breaking a CD and getting access to the money earlier, which can be a pro and con. And with CDs, they're typically taxable, when the interest is earned, right? That tax is going to flow through to the tax return. Fixed annuity, on the other hand, they may or may not have penalties for accessing the money. There may be some issues if you access the money before age 59 and a half. So they may be more of a longer term type vehicle. But on the other hand, typically the taxes are deferred until you actually take the money out. So even though it's earning interest, you're not paying the taxes when it's earned, but paying the taxes. You get to control when it's taxed by when you pull the money out and have access to it. So really, I think the takeaway is it's important for people to understand their investment time horizon, their current and future tax situation, their investment goals, and of course the rates that are available, right, for the two different options, and determining which one may be the right fit for them.
Absolutely. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got 2 items pinned up there, Mr. Armour.
All right. So one is the IRS has confirmed that they've been sending out a number of erroneous CP14 notices. You got to love the IRS CP14, right? There's all these different numbers for different types, but basically they're requesting that taxpayers pay the balance that was due on their 2023 tax return. And what a lot of people are looking at is saying, wait, I already made that payment. Why are they sending me a bill? And really, I think it's a case where the IRS computer, started sending out these notices before the IRS has been able to process the payments. They've had a nationwide delay in processing the payments. So, the tax return went in, showed that there was tax due. It was paid with the tax return, but that payment wasn't processed before the tax return was processed. and the computer's just going in and, kicking these out. So, we just want to let people know that if you receive it, don't worry. The advice the IRS is giving is to wait 6 to 8 weeks to see if the payment gets posted, because that's about the time period that it's taking them to reconcile the 2023 tax returns with the 2023 payments. And then if that payment's not reconciled within that period, then we can deal with it by just showing proof of payment, whether it's a canceled check or online payment or whatever it may be, to get any balance due or penalties removed.
All right. What's our second item pinned up there?
Well, we've got a couple summer interns, which has been kind of exciting and, brings some new life and vibrancy to the office. So we've got Carter Osborne, who's at Sac State, and then Matthew Young, who's off for the summer from Oregon State. So both of them working together. We decided to bring in 2 interns because we thought, it'd be a good way to not only for them to learn from us, but be able to discuss amongst each other and kind of work together, which seems to be working out pretty well. They're both juniors, so or at least finished their junior year and will be starting their senior year. So they still have 1 more year left in college, and they're both pursuing degrees in business administration with an emphasis on financial planning. Yeah. So really kind of, we're right in that perfect little spot in terms of allowing them or helping them take some of the things they've learned in the classroom and see how it actually gets applied to the real world.
Yeah, absolutely. Well, that's a wonderful thing. I know that for you, we've talked about it here on the past. Both of us interned in the career fields we were interested in, so it's really cool to continue to present those opportunities that were available to you to budding financial planners.
Yeah, it's a good opportunity to just give back to the profession, try and make sure that the next generation of planners are trained well and, have the knowledge and background that they need to provide good advice and help people on their financial journey. And as I said, it's also kind of fun. Usually summer's a little bit slower for whatever reason in our world. So it gives us some time and we have the opportunities to, not just, do our normal kind of day-to-day tasks and investment research and things, but to sit down and teach and explain what we do and why we do it, which makes it more interesting, seeing it through outside eyes.
Yes, sir. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Just hope everyone's able to, stay cool through this heat. Obviously, when, it starts getting into the 110, 115, right? Heat stroke and things like that are important to be really aware of and make sure that everybody stays safe.
Yes, sir. Absolutely. Well, we thank you all for listening to the Plan Solutions Incorporated podcast on whatever platform you're listening on, or if you're watching along on YouTube. That's right. Now available on YouTube. You can search Plan Solutions and you'll find us there on YouTube, or you can also subscribe or even leave comments, questions, and they get passed along to the team at Plan Solutions. And if you want to subscribe to the Personal Financial Review, the written content we discuss here on the podcast, send Katie an email. That's katie@plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.